recognition is of critical importance to companies big, small, and in between in a variety of industries. Heck, even not-for-profits have to care about revenue recognition, so it's important for all of those reasons. Governing revenue recognition, at least at the heart, was what's called the five-step approach. I give the FASB a fair bit of credit here. What they tried to do was replace the kind of, hodgepodge of revenue recognition for all of those reasons. Governing revenue recognition, at least at the heart, was what's called the five-step approach. I give the FASB rules that had built up over the years, dealing with different exceptions and unusual cases that hadn't been originally conceived of. And they tried to replace that with a single logical system that no matter what the situation was, would work. And they did a pretty good job of it, and that's the five-step approach. It should be able to be adapted, and basically has been, to any given scenario. All right, so we're going to start with that five-step approach. So at its heart, what determines revenue recognition under US GAAP? It's based upon satisfying what's called a performance obligation. You promise to do something and you do it. Either it's delivery of a good and or providing a service to a customer. Now,
recognition occur when entities satisfy performance obligation. Entities satisfy performance obligation by transferring either goods or services to customer.
that tells you when you do it or how you do it. Next question. For how much? Well, the amount should be recognized based on the expected consideration you believe to be entitled to receive from the exchange of that good or that service. And as I mentioned, all entities, regardless of being public or private, for-profit or not-for-profit, whether they sell goods, provide services, or other non-financial assets, unless, and here's the key thing, unless it's already governed by a different standard, fall under the revenue recognition standard. Why that exception? Well, the FASB looked at this and said, look, we want to fix this. We want to create a cleaner way of doing revenue, but there are some assets, some different types of transactions, which we have more recently dealt with, and we don't want to throw out the rules that are well thought out. So we don't want to override those. We're going to scope them out of the revenue recognition standard. These included leases, insurance, non-warranty guarantees, and financial instruments. Okay. So what is the five-step approach? And you know us, we do love a good mnemonic. So here's the mnemonic to remember here. It's I am a star, or if you prefer, just I-STAR for short. I-S-T-A-R. The I, you have to identify the contract. The S, determine what are the separate performance obligations in that contract. T, what is the transaction price? 4, allocate. A, allocate that price to the obligations, or the way I always look at it, step 4 is merging steps 2 and 3 together in a logical way. And then step 5, the R, is to recognize revenue, and there's 2 different ways that can occur. So that's it. I-S-T-A-R. So let's start with, well, the I. Revenue. And there's two different ways that can occur. So that's it. ISTAR. So let's start with, well, the I, identifying the contract. So a contract here is defined as an agreement between two or more than two parties, and the whole notion is it creates something enforceable, rights for one and obligations for the other. Now, one easy question. Oh, if it's a contract, does it have to be in writing? No. Is a verbal contract potentially going to be enough? It could be, especially if that's the typical business contract practice. Could it even be implied? Yeah. What the FASB said here is that if a customer has a reasonable expectation, for example, if they have talked to other customers and said, you know, every other customer you sold to for the last 20 years, you offered, let's just say, some training services. You never put that in the contract, you never sell it, you never put a price to it, but you always do it. So we would assume you do the same for us. That's an implied contract, even though it was never explicitly discussed. Ultimately, the customer is just one party in this arrangement. And it says, I'm reaching out to you in order to obtain goods or services that are part of your daily operation. This is what you do as a business. We want you to do it for us, and are willing to pay for it. Now, with each of these, I almost want you to picture folks sitting in a room. The FASB's on one side. They're the ones that have written these rules. And a whole bunch of accountants and CPAs and industry folks and all these other folks are like, but wait, I want to make sure I understand this. And they're asking questions. For example, they said, well, what makes a contract? You almost could hear that first one was like, well, does it have to be in writing? And the FASB said, no. But then someone said, well, let me clarify that. Is anything and everything potentially a contract, or are there certain things that would not count as a contract, and does that even matter? And the FASB said, oh, it matters, because if there's no contract, you can't get past step one. There has to be a contract. But here's what it requires. Number one, all parties have to have committed and approved, meaning basically saying, I promise you, you promise me, we are now obligated to each other to perform those responsibilities, and each party has approved. I call that the, did you sign the contract? Second, the rights, the specific rights that accords each party are identified. In other words, the contract delineates, I promise this, you promise that. Third, the payment terms have to be identified. I promise to pay you $50,000 60 days after delivery of such and such. 4, the contract must have commercial substance. But that's a fairly, I don't want to say low bar, but it's a straightforward bar to get over. It says, because of this contract, because of this transaction, did the future cash flows change? And if the answer is yes, then you've got commercial substance. And finally, probable that collection of consideration is going to happen. Doesn't preclude the fact that there could be a bad debt down the road, but at inception, you say, no, I wouldn't have signed this contract if I didn't think it was probable I'd get paid. If you've met all of those criteria, congratulations, you do indeed have a contract, and you now know what you need to target for step one. Now, it is performed at the inception of the contract. So then, again, think of that group going, hold on, what about if there's a change in the contract? Generally, only if those changes are significant would it necessitate a reassessment. However, if it does not meet all those criteria at inception, does that mean, oh, you're done? It's not a contract, good, never need to worry about it again? No, they said, no, you should reassess it, because it could be that at inception, you've met 4 of those requirements, and perhaps 6 months later, you'll meet the 5th. And if you do, well, then you've met all the conditions, and now you can move forward to the next steps in terms of revenue recognition. Remember, if you're trying to recognize revenue, you want to get through step 1. You want to have a contract that meets all the requirements. Now, if it's not met, what if the customer says, well, whether or not you can call it revenue or a contract under the revenue standard, I'm still required to give you a deposit, so here you go. Can they recognize revenue under specific circumstances? If the consideration is non-refundable, so say it's a non-refundable deposit, and there are either no remaining obligations, meaning everything the contract required me to do, I've done, or the contract has since been terminated, basically saying, well, you've terminated the contract, I don't have to do anything else, and that deposit you gave me, I get to keep it. Then it's revenue. Unless or until those things happen, it's simply a liability. It's an unearned revenue. It's a prepayment in that sense. Another key question. What if you have multiple contracts? Well, the way the FASB looked at this, they said, well, it depends on why you did that. If you entered into a dozen contracts, but all 12 were with the same customer or with a bunch of parties related to that same customer, you negotiated them all around the same time, then it's appropriate to combine them, because in substance, it really was just a multi-part single deal. So if they were, and that's typical if you negotiated them as a package of contracts, meaning they really were all part of the same objective, or if the consideration from one contract is tied to the performance or the price of another, meaning they don't really operate solo, they're joined at the hip, or the goods or services promised under that battery of contracts really are one single performance obligation. I look at this as more of a common sense rule to say, the form may be multiple contracts, but is it really that in substance? If the answer is no, in substance it's really one giant deal, treat it that way. What about if the contract is later modified? Now that could be the price has changed, or the scope has changed, or both, as long as that's approved by both sides. Two possible ways that can be handled. One is to say, well, this is a new contract. The other is to say, no, it's a modification of the existing contract. It's a modification, or it's treated as a modification as a new contract, meaning when would you say, no, it doesn't do anything to the original contract, this is something new. One is, and really the way I've explained this over the years is, it really is adding something new and different to the deal. So if the scope has increased, there are new goods, there are new services, and the increase in the overall price is commensurate with the sales price for those extra items. Think of it as, well, when I first negotiated this deal, I didn't want to buy the installation services. Later on, I find I clearly have not done a very good job installing it, so I reach back out and say, can we add that to my contract? And that's what they do. They add a new service, installation, and they say, well, normally when we just charge someone for installation, we charge them X, we're going to charge you that. Then that modification would be treated as a new contract. Otherwise, it's treated as a modification of the existing contract with revenue being adjusted accordingly. Okay. Once you have the contract and you say, I've got it, I figured it out. I go, great, you finished one step out of 5. You're on your way. But the next step of the game here is the S. What are the separate performance obligations? Now, if you might guess that for some companies, this is easy. Because they may say, yeah, we have a contract. It obligates us to do one and only one thing, and that's it. Great. But plenty of contracts don't work that way. They may have multiple performance obligations. So what is a performance obligation? It's a promise. It says, I promise to give a good, provide a service, whatever it is. That transfer could be a single thing, one good, one service, or it could be a bundle of related goods and services as long as it's distinct. Or it could be a series of goods or services that are basically all the same or substantially so and are transferred in a similar manner. If it is not distinct, then it has to be combined. So if the contract says, well, here's an obligation, here's an obligation, here's an obligation, but they are not distinct from one another, it's obligated that you combine them into one performance obligation. So here's where we get some real fun wordplay. All right, Mike, you said it has to be a distinct performance obligation. What the heck does distinct mean in this context? Number one, the promise, whatever the promise is, has to be separately identifiable. So if you look at a contract and you go, no, there's literally a one performance obligation. So here's where we get some real fun wordplay. All right, Mike, you said it has to be a distinct performance obligation. What the heck does distinct mean in this context? Number one, the promise, whatever the promise is, has to be separately identifiable. So if you look at a contract and you go, no, there's literally a list of 1, 2, 3, 4, 5, and I can clearly and separately see what 1, 2, 3, 4, and 5 are. Then you'd satisfy condition number one. Perhaps more importantly, though, if that's all the customer got was item number 3, by itself, could they benefit from just item number 3? And or could they use the resources they already have on hand so that they could then benefit from item 3? If that's the case, they can benefit from it on its own, and the promise is separately identifiable. That is a distinct performance obligation. Otherwise, it's not. Now, as far as separately identifiable goes, what defines a separately identifiable performance obligation? Well, one is the entity says, well, we don't integrate that. It's not this good as part of a bunch of others. It's not this service is integrated to other contract services. It stands alone. I can identify it separately. It doesn't customize or modify something else in the contract, and it doesn't depend upon, nor does it relate to other things in the contract, meaning, no, it stands by itself, it stands alone. That's separately identifiable. What if it's not? Well, if there are factors that would lead you to believe that two or maybe more than two promises involving goods transferred or services provided are not separately identifiable. In this case, things like the goods or the services in question are highly interdependent. Or at least highly interrelated to one another, or the entity provides a significant service designed to integrate that good or service with other things in the contract, would lean towards it being a bundle of some kind, meaning it's not just one separately identifiable, it's a whole bunch of things together which can be separately identified. I know this may get a little bit, at least with the wording involved, gets a little bit fuzzy, so why don't we take a look at an example. So we have Tanner Company, and Tanner is building a multi-unit residential complex. So maybe it's a set of condominiums. And the entity has a contract with one specific customer to finish building out one specific unit. Now, the goods and services include procurement, construction, piping, wiring, installation, equipment, or installation of equipment, and finishing. So basically everything you think about when you contract or work with someone to build you something. So what are the performance obligations? Well, are the different goods and services provided by the contract in this case capable of being distinct? Yes, they're capable of it, but are they? No. Why? Well, because they cannot be separately identified from the overarching promise, which is, I promise to build you a unit. All these different things, from procurement to construction to piping and wiring, they're not separate. They're all part of that one objective to build out the unit. In fact, the contractor very clearly is going to integrate these things, right? The piping, the wiring, the various pieces of equipment, all of that is integrated into providing this one thing, this unit. So in this case, all of it would be combined into one performance obligation, and the revenue would be accounted for accordingly. How about this one? A software developer enters into a contract with a customer, and they say, here's what we're going to do. We're going to transfer a software license to you. We're going to perform installation of that software. We're going to provide ongoing software updates, and we're going to provide ongoing technical support with that ongoing service for the next 5 years. Now, question, does the developer sell each of those independently? And the answer is yes. The license, the installation, the updates, and the technical support, if a customer came to them and said, we just want one of those, absolutely, they sell those separately. In this case, the entity would say, each of those independent goods and services is separately identifiable. Because, does each piece modify it? No, the installation doesn't change the software, it simply installs it. That's not the same thing. Does the software only work with updates? No. Does it only work with technical support? Well, arguably, if you don't know how to fix it yourself, over time, maybe not, but the idea is that, no, you can get along without it if you don't want it. All of that lends itself to those are separate. So in this case, the software is delivered first, then it's installed, and then on an ongoing basis, we have the updates and technical support. Can the customer benefit from each of those independently of the others? Sure, each one does provide its own value. So in this case, they're separately identifiable, they're distinct. We've got 4 separate performance obligations. the license, the installation, the updates, and the technical support. All four would be separate obligations. All right, that gets us through the first two steps of the five-step process, which quick math tells me we've got three more steps to cover: the T, the A, and the R. So we'll see you on the next one. Welcome back as we continue our grand tour of the five-step approach to revenue recognition under U.S. GAAP. Previously, we were going through the I star, or I am a star mnemonic. We tackled the I and the S, which means it's time now to deal with the T. The T is to determine the T transaction price. Now, this is defined as the amount of consideration that an entity would expect to receive or be entitled to receive in exchange for, well, frankly, doing whatever it is they're doing, good or service being provided. Now, earlier with step 2, I had said, well, for some companies, that's easy. They have a contract. It has exactly one obligation, no ifs, ands, or buts about it. Well, similarly here, some contracts may say the transaction price is $50,000, period. That's it. So it's not hard to determine what it is. However, again, we could imagine in that room, be on one side, companies on the other, look at each other going, well, wait a minute though. Do we have to factor in variable consideration? So what if the price in the contract can actually change based on certain conditions or other constraints? And the answer is, well, yeah, you include that, or you have to incorporate that. What if there's a significant time element such that there's financing involved? Yeah, time value of money could be relevant. What about not non-cash considerations? Is that something we have to factor in? One more time, the answer is yeah, you sure do. What if there's any consideration that's being paid back to the customer, maybe a rebate or other incentive? One last time, the answer is yeah, probably. So it's holistic. The idea is the transaction price should incorporate anything and everything that's relevant to that transaction. So let's tackle some of these more unusual issues, because the core price, if I said $50,000, there's not a whole lot else I have to explain. That's what it is. But what about these other situations? Well, what about variable consideration? Here's the way that works. You're supposed to estimate it. So first off, you are thinking, okay, I could end up paying you between $50,000 and $80,000. And that's exactly where I have to start. What is the range of possible amounts? Then I'm going to come up with one of two better estimates. Option one, I could say, you know what? I'm going to probability weight it. I could say, well, I think there's a 30% chance it'll be 50,000, there's a 40% chance it'll be 60,000, 20% chance it'll be 70, and only a 10% it's 80. Fine, you take the probability weighted total and come up with a number that way. Or if there is an amount in that range that is most likely. So for example, if I said, yeah, it could be between 50 and 80, but honestly, I think the chances are probably 70%, it's going to be 62. Well, then use 62. Ultimately, whichever is deemed the better predictor is the one that should be used. Now, there is a constraint to this. It says, well, you should certainly include variable consideration, that's fine, and you should make that part of the price, as long as it is probable that a significant reversal of the revenue will not be required once any uncertainty is resolved. So that is, and that's not just in this rule. Frankly, the FASB doesn't like that in general. They're not big fans of accounting rules that create earnings volatility. And if you were to basically over-recognize revenue only to have to reverse it later, that's volatility. And the FASB says, no. If you're going to include this, that's fine, but not if you believe it is anything less than probable that you're going to end up having to reverse some or all of it in the future. What about financing? Well, the idea here is that if the timeline is part of the price, in other words, it's not just you got to pay me $50,000, but you're going to pay me back in installments for the next 5 years. Well, that's relevant, right? That is absolutely part of the price. And so if there is that kind of a benefit generated by time, effectively a financing benefit, then that should be incorporated into the price as well. Now, if the time is less than a year, then it's deemed short-term regardless, and it's not necessary to apply discounting, even if you would look at the substance and say, well, there is a financing element, less than a year, it's not deemed to be material. What about non-cash consideration? Well, that one's easy. Fair value. Whatever it is, you measure it at fair value and include that as of the contract inception. Similarly, what about consideration that is paid back to the customer? Well, that's seen as a reduction. It's effectively a rebate of that portion of the transaction price, and therefore would reduce the revenue being recognized, in general, anyway. So why don't we take a look at a quick example with the time value of money as a factor. So on January 1 of year 5, SDF sold furniture to a customer for $4,000, but they did it using some